Now we're going to go over accounting fundamentals 2. Our goals for accounting 2 are going to be to learn the purpose of the accounting system, understand the double entry accounting system, discuss the differences between the cash versus accrual methods, learn the accounting cycle, understand the chart of accounts, general ledger, and trial balance. Table of contents. We're going to go over the introduction, which is the purpose of the financial system and statements, and Chapter 1, which is financial accounting and processes, and Chapter 2, understanding financial statements, and then Chapter 3, characteristics of an accounting system. Purpose of the financial system and statements. Financial statements form the basis for understanding the financial position of a business firm and for assessing its historical and prospective financial performance. Financial statements have the capability of presenting clear representations of a firm's financial health, leading to informed business decisions. Financial accounting is concerned with the summary, analysis, and reporting of financial transactions pertaining to a business. This involves the preparation of the financial statements available for public consumption, and we went over this before. There are 4 financial basic statements: a balance sheet or statement of financial position, an income or earnings statement, the statement of stockholders' equity, and the statement of cash flows or your cash flow analysis. For a corporation, these forms can be found in the Form 10-K or their annual report. To be useful, the accounting information must possess the characteristics of reliability, relevance, understandability, and compatibility. The functions of the management of the company are to plan operations, to control operations, and to evaluate operations. To perform these functions effectively, management must have information about what the business has done, about what it is currently doing, and about where it looks like it is going or should be going. And this is to make better decisions and judgment, which affects a company's performance. Like we talked about before, financial statements are based on a set of guidelines called Generally Accepted Accounting Principles, or GAAP. These guidelines are not exact rules. To make financial statements useful, we need to understand guidelines and the choices used to construct them. The phrase Generally Accepted Accounting Principles, or GAAP, consists of 3 important sets of rules. Number 1, the basic accounting principles and guidelines. Number 2, the detailed rules and standards issued by FASB and its predecessor, the Accounting Principles Board, APB, and the generally accepted industry practices. There are other governing guidelines and government entities that keep track of everything. The SEC is the U.S. Congress established the SEC in 1934. The SEC is at the top of the authority chain. It was formed to set the rules for corporations that trade on the public stock exchanges. The Public Company Accounting Oversight Board is a group that was formed to oversee the auditing profession and the audits of public companies. Its creation was mandated by the Sarbanes-Oxley Act of 2002. Auditing standards are set by the PCAOB. The Financial Accounting Standards Board, the FASB, is a group of professional business people who has the responsibility of setting current accounting standards. That sets accounting standards. The accounting standards, called Generally Accepted Accounting, the GAAP, are set by the FASB. The SEC, which is the Securities Exchange Commission, has delegated much of the standard-setting responsibility to the FASB. However, the SEC retains and sometimes exercises the right to set accounting standards. The FASB gets its authority from the SEC. Financial accounting is recording financial information, classifying financial information, summarizing financial information, and communicating information. And that's the overall process. There are 5 major sets of classifying accounts all companies track: assets, liabilities, equity, income, and expenses. So in business versus personal finance, like we went over before, sales, it's sales versus revenue. Expenses can be cost of sales versus your work expenses. Profit can be the difference between sales and costs, or savings and amounts invested. And everything else is pretty generally the same. It's all based off of your success, increasing sales and profits versus increased income resulting from accumulated salary, investments, and savings. Financial management information is split into two accounting equations. Central relationships that have been used to describe financial management. A balance sheet is assets equals liabilities plus equity. The income statement is revenues minus expenses equals net income. And those are the general accounting equations. The accounting balance sheet is one of the major financial statements used by accountants and business owners. The balance sheet is also referred to as the statement of financial position. The balance sheet presents a company's financial position at the end of the specified date. Some describe the balance sheet as a snapshot of the company's financial position at a point, a moment, or an instance in time. For example, the amounts reported on a balance sheet dated December 31st, 2009 reflect that instance when all the transactions through December 31st have been recorded. Because the balance sheet informs the reader of a company's financial position as of one moment in time, it allows someone like the creditor to see what a company owns as well as what it owes to other parties as of the date indicated in the heading. This is valuable information to the banker who wants to determine whether or not a company qualifies for additional credit or loans. Others who would be interested in the balance sheet include current investors, potential investors, company management, suppliers, some customers, competitors, government agencies, and labor unions. The value of assets and liabilities are known as historical values in that all the values are put in the balance sheet at cost, except in cases of market-to-market. And here's an example of a balance sheet. You have you have the assets and your liabilities, and we're going to go over what each one is. As you can see, in the end, total assets equals liabilities plus shareholders' equity. In this figure, it's $770,000, and over here it's $770,000. So long-term assets are property, plant, and equipment. It includes land, buildings, leasehold improvements, equipment, furniture, fixtures, delivery. Land, the cost of real property exclusive of the cost of any constructed assets on the property. Land usually appears as the first item under the balance sheet heading of a property, plant, and equipment. Generally, land is not depreciated. Buildings show the cost of a building excluding the cost of the land. Buildings are depreciated over their useful lives by debiting the income statement account depreciation expense and crediting the balance sheet account accumulated depreciation. Contra asset account, which tracks total amount of depreciation. Equipment is tangible property other than land and buildings, which is durable and useful for carrying out the operations of a business. And then you have your vehicles, like your construction vehicles, your cars you need to use for doing work. Your other assets are prepaid and deferred assets, expenditures for future costs such as prepaid insurance, prepaid rent. These are current assets, which indicates the cost of contracts, premiums, that have been paid in advance. It represents the amount that has been paid but not yet expired as of the balance sheet date. And then for your intangible assets, you have patents, trademarks, copyrights, and goodwill. And then you have intellectual property. But for patents, trademarks, and copyrights, patents, as you know, if you have an invention, it's the patent, which is the right to the invention, the trademark, which if you have a brand logo, and then a copyright is if you write a book or something and the content is owned by you. Goodwill would be when a company acquires another company for a price in excess of the fair market value of net identifiable assets acquired. The excess price is recorded on the books of the acquiring company as goodwill. And then you have your intellectual property, which is property that can be protected under federal law, including copyrights, works, ideas, discoveries, and inventions, include novel sound recordings, a new type of mousetrap, or a cure for a disease. Unlike tangible assets to your business, such as computers, intellectual property is a collection of ideas and concepts. Liabilities are reported on the balance sheet and are usually divided into two categories. Current liabilities. These liabilities are reasonably expected to be liquidated within a year. They usually include payables such as wages, accounts payable, taxes payable, sales taxes payable, short-term obligations for the purchase of equipment, and others. Long-term liabilities are reasonably expected not to be liquidated within a year. They usually include issued long-term bonds, notes payables, long-term leases, mortgages, pension obligations, and long-term product warranties. Shareholders' equity in a publicly traded company is the amount of money initially invested in the company plus any retained earnings. It represents the source of the business's funding. In order for the balance sheet to balance, total assets on one side have to equate total liabilities plus earnings on the other, which is what we explained before. And then you have your net worth, the amount by which a company's assets exceed their liabilities. For a company, this is known as shareholders' equity. It is determined by subtracting liabilities on the balance sheet from assets. So, one more time, just bringing it up. You have your current assets, cash, petty cash, temporary investments, accounts receivable, inventory, supplies, prepaid insurance, your investments, your property, plant, and equipment, which we explained, your intangible assets, your other assets, equaling that, your current liabilities, notes payable, accounts payable, wages, taxes, warranty, your long-term liabilities, total liabilities, and your stockholders' equity, and your common stock value, your retained earnings, which you make at the end, which the owners make, or what the company makes, less your treasury stock and your total shareholder equity. Now let's talk about the income statement, which is one of the major financial statements used by accountants and business owners. The income statement is sometimes referred to as the profit and loss statement, or P&L. It's a statement of operations or a statement of just income. The income statement is a summary of all the revenues from sales and services a company earns, minus all the expenses, costs incurred in the earning process associated with earnings that from revenue. It describes the performance of a company during a specific period of time. The income statement is important because it shows the profitability of a company during the time interval specified in its heading. The period of time that the statement covers is chosen by the business and will vary. For example, the heading may state, for the 3 months ended December 31st, 2009, the period of October 1st to December 31st. The 4 weeks ended December 27, 2009, the period of November 29th through December 27th. The fiscal year ended September 30th, the period of October 1st, 2008 through September 30th, 2009. Here's an example of an income statement. For example, company, which has revenues minus cost of goods sold equals its gross profit minus expenses, and then minus the tax equals your next net income, which we will explain. Revenue is the amount of money that a company actually receives during a specific period, including discounts and deductions for returned merchandise. Income in businesses can refer to a company's remaining revenues after all expenses and taxes have been paid. In this case, it is also known as earnings. Net income or net loss is the bottom line of the profit and loss statement, also known as the income statement. For expenses, it is common for expenses to occur before the company pays for them. Example, wages earned by employees, employee bonuses and vacation, utilities, and sales commission. They don't happen until they actually occur, but they're still accounted for. However, some expenses occur after the company has paid for them. For example, let's say a company buys a building on December 31st, 2009 for $300,000, including the cost of land. The building is assumed to have a useful life of 30 years. The company paid cash for the building on December 1st, 2009, but it will record depreciation expense of $10,000 in each year of the years 2009 to 2038. Cash payments do not always mean that an expense has occurred. For example, a company might pay $20,000 to the bank to reduce its bank loan. The payment will reduce the company's cash and its liability to the bank, but it is not an expense. A company's total earnings or profit, net income, is calculated by taking revenues and adjusting for the cost of doing business, depreciation, interest, taxes, and other expenses. This number is found as the bottom line of the company's income statement and is an important measure of how profitable the company is over a period of time. Often referred to as the bottom line, since net income is listed at the bottom of the income statement. Net income is calculated by starting with the company's total revenue. From this, the cost of sales, along with any other expense that the company incurred during the period, is removed to reach earnings before tax. Tax is deducted from this amount to reach the net income number. Net income, like other financial measures, is susceptible to manipulation for such things as aggressive revenue recognition. When basing an investment decision on net income numbers, it is important to review the quality of the numbers that were used to arrive at this value. A measure of a corporation's profitability calculated as net income divided by revenue. The ROR is useful in comparing the profitability of a company from year to year. Intrinsically, the difference between net income and revenue is expenses, such that an increasing ROR implies less expense for higher net income. And ROR is return on revenue. So, if you look at our income statement again, you have revenues, sales of $660,000 plus discounts, returns at $653,000. Cost of goods sold, beginning inventory, what it added, what it less, net purchases, goods available for sale, less inventory, cost of goods sold at $283,000. So gross profit, which is $653 minus $283, is $370. So for selling expenses, it has advertising expenses for your marketing promotions. The freight out, for here freight out is probably transportation, which is at $4,000. Depreciation on its equipment and buildings is $28,000. The utilities it has to pay to run the factories is $11,000. The utilities would be like the gas, heat, electric, hot water. And then the salaries you pay for managers, which is $29,000, and those total to $142,000. Then your general and administrative expenses are your salaries, I'm guessing, to employees for $663,000. Your depreciation of $17,000, more utilities, your insurance, and then the rent. Other would be loss on sale of land, interest expense, that's $9,000, income before tax, $49,000, income tax expense is $10,000, and your net income is $39,000, which would be $370 minus $321 is $39,000, and your return on revenue would be $39,000 divided by 653,000, which equals about 6%. Moving on, your statement of cash flows is the third important financial statement. This statement shows all the cash collected and all the cash dispersed during the period. Each cash amount is classified as one of three types. Cash from operating activities, which is cash transactions that relate to the everyday routine transactions needed to run a business. Then you have your cash from investing activities, which are transactions involving sale and purchase of long-term assets used in the business. Then you have cash from financing activities, which are transactions related to how a business is financed, which would be like the loans. Here is an example of a cash flow statement. You have the cash flow from operating activities, which is your net income of $1,000, and then you would add or deduct anything on operating income, so depreciation expense or gain on sale of land, which is minus, increase in accounts receivable, decrease in inventory, increases in account payable, decrease in wages, and you get net cash of $800,000. Your cash flows from investing activities. Well, you sold the land of $750,000. You purchased equipment of minus $150,000. So your net cash from investment activities would be $600,000. Then your cash flow from financing activities would be a proceeds from issuing stock of $80,000 minus the dividends that you gave out of $50,000, and then you repaid the long-term loans of $900,000. Net cash would be a deduction of $870,000, which you would still get a net increase in cash because it's 800 plus 600 minus 870 of $530,000. So your cash balance on January 1st was 170. Cash plus the 170 plus the 530 would give you a current cash balance of $700,000. Your non-cash investing financing activities, your preferred stock for buildings, $300,000. Your supplemental information, cash paid for interest, and cash paid for expenses. These aren't really included usually, but this is the magic number that you want to end up with that. And this is the number investors are going to look at, your shareholders and whoever. So let's go back over the characteristics of an accounting system. The most general and the most important objectives of financial reporting is to provide useful information for making decisions. According to the FASB, there are 4 points which make information useful. It has to be relevant information, reliable information, comparable information, and consistent information. For information to be relevant, it needs to be significant enough to influence business decisions. The information should help confirm or correct the user's expectations, no matter how significant the information is. However, it must be timely to be relevant. For instance, one must know current interest rates in order to price products to potential customers. When information is reliable, you can depend on it and you can verify its accuracy. The information is completely independent of the person reporting it. To be reliable, the information in the financial statements must be a faithful representation of what it intends to convey. For instance, accuracy in gross revenues from interest on loans needs to be relied upon in order to compare it against expenses. Useful information possesses comparability. This means investors will be able to compare corresponding financial information between two similar companies. How one company's net income compares to another company's net income. In putting together financial statements, accountants must allow for meaningful comparisons. In this way, it is important for shareholders and potential shareholders to have meaningful information to evaluate their financial investment in the company. Consistency is the characteristic that makes it possible to track a company's performance or financial condition from one year to the next. Only if a company uses the same accounting methods from period to period are we able to make meaningful comparisons. For example, one can evaluate a company's total revenue from year to year. If there is a major difference, consistency in accounting methods will allow the evaluator to make assumptions such as the method of measuring sales did not differ from year to year. There are general rules and concepts that govern the field of accounting. These general rules, referred to as the basic accounting principles and guidelines, form the groundwork on which more detailed, complicated, and legalistic accounting rules are based. For example, the FASB uses the basic accounting principles and guidelines as a basis for their own detailed and comprehensive set of accounting rules and standards when evaluating financial information. The accountant keeps all the business transactions of a sole proprietorship separate from the business owner's personal transactions. For legal purposes, a sole proprietorship and its owner are considered to be one entity, but for accounting purposes, they are considered to be two separate entities. This is an economic entity assumption. For a monetary unit assumption, economic activity is measured in U.S. dollars, and only transactions that can be expressed in U.S. dollars are recorded. Because of this basic accounting principle, it is assumed that the dollar's purchasing power has not changed over time. As a result, accountants ignore the effect of inflation on recorded amounts. For example, dollars from a 1960 transaction are combined or shown with dollars from a 2006 transaction. The time period assumption. This accounting principle assumes that it is possible to report the complex and ongoing activities of a business in relatively short, distinct time intervals, such as the 5 months ended May 31st, 2006, or the 5 weeks ended May 1st, 2006. The shorter the time interval, the more likely the need for the accountant to estimate amounts relevant to that period. For example, a property tax bill is received on December 15th of each year. On the income statement for the year ended December 31st, 2006, the amount is known. But for the income statement for the 3 months ended March 31st, 2006, the amount was not known and an estimate had to be used. From an accountant's point of view, the term cost refers to the amount spent, cash or the cash equivalent, when an item was originally obtained, whether that purchase happened last year or 30 years ago. For this reason, the amounts shown on financial statements are referred to as historical cost amounts, and this is the cost principle. The full disclosure says if certain information is important to an investor or lender using the financial statements, that information should be disclosed within the statement or in the notes to the statement. It is because of the basic accounting principle that numerous pages of footnotes are often attached to financial statements. The going concern principle assumes that a company will continue to exist long enough to carry out its objectives and commitments and will not liquidate in the foreseeable future. If the company's financial situation is such that the accountant believes the company will not be able to continue on, the accountant is required to disclose this assessment. The going concern principle allows the company to defer some of its prepaid expenses until future accounting periods. The matching principle requires companies to use the accrual basis of accounting. The matching principle requires that expenses be matched with revenues. For example, sales commissions, Expenses should be reported in the period when the sales are made, and not reported in the period when the commissions were paid. Wages to employees are reported as an expense in the week when the employees work, and not in the week when the employees are paid. If a company agrees to give its employees 1% of its 2007 revenues as a bonus on January 15, 2008, the company should report the bonus as an expense in 2007 and the amount unpaid at December 31st, 2007 as a liability. The expense is occurring as the sales are occurring. That is the matching principle. For the revenue recognition principle, under the accrual basis of accounting as opposed to the cash basis of accounting, revenues are recognized as soon as a product has been sold or a service has been performed, regardless of when the money is actually received. Under this basic accounting principle, a company could earn and report $20,000 of revenue in its first month of operation but receive $0 in actual cash that month. Because of the materiality principle, can't say that word at all, or guideline, an accountant might be allowed to violate another accounting principle if an amount is insignificant. Professional judgment is needed to decide whether an amount is insignificant or immaterial. Because of materiality, financial statements usually show amounts rounded to the nearest dollar, to the nearest thousand, or to the nearest $1 million, depending on the size of the company. Conservatism happens if a situation arises where there are two acceptable alternatives for reporting an item. Conservatism directs the accountant to choose the alternative that will result in less net income or less asset amount. Conservatism helps the accountant to break a tie. It does not direct accountants to be conservative. Accountants are expected to be unbiased and objective. And that concludes Accounting 2.